All right, Yield Nerds. Hello again after a good pause for a couple of weeks. I wanted to wait until the end of the year so I could introduce you to a very new and very different concept. Some of you may already be familiar with what are called oil and gas royalty trusts. Let's learn all about them. Before I go any further, my usual disclaimers. This is not investment advice, it's education. You make the decisions. I am not a wealth management advisor. I'm not pitching any product. I do not have merchandise to sell. This is purely my sharing, my information, and I do not have a political stance to impart to you. What you do is your own choice. Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, so what are we going to talk about? We'll review what an oil and gas trust is, or a mineral trust is in general, as they're called, why they were created. We're going to look at three publicly traded oil and gas trusts and then figure out where we go from there. Couple of things in terms of this show. If you're not familiar, there is a playlist on this show. I have attached a reference to it. You will see that right there. And so feel free to use that playlist and you can see the content organized in the order in which it'll make it easier for you to understand. And there also are additional resources that are available. And as you go through the content, you will see that. All right. Let's actually start with something we all know. Real estate investment trusts, even if you do not have an investment in it, you probably have heard of the term REITs. So, what is a REIT? And there's a reason why we're talking about it, because it has a lot to do with oil and gas trusts. So, you walk around, you drive around your neighborhood, and you see an empty lot in the street corner. And turns out somebody that you know, or somebody that you know knows somebody who says, gee, I wonder what will happen if we buy that plot and we put a little strip mall in there. And they raise money, they go buy that plot, they build a strip mall, they start signing up all these stores. As the stores pay them rent, they give the investors a slice of the pie. In effect, that is what a REIT is. They offer generally higher income. There are some tax advantages there. They are riskier bets than bonds, for example, because there is no guarantee in some cases. The premise is that you trust other people to buy land. You fund the acquisition of the land, and in some cases, the development of the land as well. Some of you may own storage facilities, apartment building stock, and things like that. And when the buyer of the property turns around and pays rent to the REIT then grabs it. They take a management fee and they give the rest to you as a dividend, and that's generally how REITs work. So, kind of a very simple thing that you've seen all around. You've seen strip malls come about, you've seen gas stations, you've seen, apartment buildings. Many of those are owned by REITs. What does that have to do with our world? The oil and gas trust is a different kind of REIT in some ways and not at all in others. That same street corner probably wouldn't look like this highly populated suburban street corner, but more like the latter. It might be in the West Texas Basin, or it might be in a different part of the country where there isn't a lot of development going on. Some of them are springing up in big cities, like the suburbs of Denver. So, depending on where minerals are, in this scenario, you are funding the acquisition of land and you may have co-investors that are big names. The trust then says, okay, we're going to go find the operator. Here again, it's different than the REIT. The REIT sometimes may hire builders, sometimes the REIT may have its own builders. Here, by definition, there is a non-operator trust. So the oil and gas trust says our job is to take the money, buy the land, and go find other people who will dig the ditches and look for the oil and transport the oil and build the pipeline and so on. And the lessor, the person who is taking the land, prospects for whatever mineral it may be. The most common oil and gas trust just does straight up oil, natural gas. There are non-gas substrates that they may get as well called NGLs. We can talk about them later. And they may lay down certain conditions. If X is true and Y is true, then we pay you a royalty. And eventually, there is no such thing as unlimited mineral supply. Eventually, the production of that well dries up. And when the production of that well dries up, then the lessor says, hey, my output is much lower now than it was when I began to take the oil out of the ground. And so I'm spending just as much energy to get a lower output. So I'm going to be done and I'm going to move somewhere else. And when they do that, you paid for the land, your royalty stops. The trust then sells the land for whatever is the fair market value. And in some cases, the operator may be the one buying it at a favorable deal. And these kinds of things are structured in a way that you don't have control. But in reality, big oil may be buying that land and they may say, we're going to go ahead and take oil out of here for 5 years, 10 years, how many ever years. When it's done, we'll assess the fair market value and we'll take it as a percentage of the worth or at the fair market value or at the lower of the two. And those kinds of things are already there in the lease. And so that's generally how a trust is structured. Here's what we're going to do. Then ask the wonderful question, why do we need that? Big oil generally has so much money, they don't need anybody to do this. Well, the answer is taxes. If big oil were to buy the land, they put a big asset on their books, they have to then find the capital expenditure to do that, and then they have to pay taxes on, the work that is done, the income that is generated. Instead, the idea is to separate the risk in small layers. Big oil says, we take the oil that comes from the ground, we prospect, and if we don't find the oil, then we walk away. We don't have the risk of owning a patch of land that doesn't produce. That's at least a theory. Another thing that does is big oil can then focus on prospecting in 100 of these sites instead of buying 5 of them and prospecting in them and figuring out how to resell them. So there is a flexibility for the operation of it. They don't need to issue new stock because the capital intensity is much lower. The land maintenance costs, and all of us have read sometimes terrible news about leaks of pipelines. And so some of those costs are borne by the trust, some, not all, and you have to look at what the contract says because the operation of the mineral prospecting is the operator's liability. So there are pros and cons to how to do this and why it is done. But in theory, the idea is that if you were to structure a trust to own the land, if you were to structure another company to prospect it, another one to transport it, another one to retail it, the enterprise value of it is much greater than one single behemoth that does it all. And also there is pricing power and monopoly considerations, and that's why it's structured like that. So having said that, here's what we're going to do. We're going to take 3 publicly traded oil and gas trusts and go through them and understand what is going on. Very important disclaimer, I'm not recommending that you buy them. I'm not telling you to not buy them. This is purely education. The first one we'll look at is BPT. It's Prudhoe Bay Trust. It's in the Prudhoe Bay of Alaska. And the dividend yield, a very, very nice 31.21%. In other words, if you bought that for $1 and you waited roughly 3 years, you would get your dollar back. And if it paid anything in the 4th year, that's pure profit. That's the theory anyway. That's Prudhoe Bay. MVO or MV Oil Trust has a dividend yield of 14.92%, and MNRL, Brigham Mineral Trust, with a dividend yield just shy of 10%. So we'll go through these, we'll understand how they are set up, what their conditions are, how this works as an investor's viewpoint, and then take it from there. So let's get to Prudhoe Bay. It's kind of cold out there, as you can imagine, and let's see what goes on. So specific to Prudhoe Bay, This is one of the largest oil and gas trusts in the United States. At one point, it was valued over $1 billion. And the idea is that if you're an investor in BPT, as long as the operator takes more than 90,000 barrels a day of oil, you will get 16% of the revenue of that oil. Let me read that one more time. Two things need to happen. The operator has to take more than 90,000 barrels a day. And if they do that, you, the investor, will get 16 cents on the dollar. And if the operator takes less than 90,000, as you can imagine, you get a smaller number. And so there are a couple of things. And if the operator takes 200,000 barrels a day, you only see 16 cents of the dollar for the first 90,000 barrels and your fraction or your share of the trust of that number. So that's the theory. You can sit here and say, well, the world needs oil, America needs oil. This is the best thing since sliced bread. You know, Alaska has a ton of oil. It's just going to keep producing oil forever and ever and ever. The end, we can all go home and retire at a 30% dividend producing BPT, the end. One quick thing. Let's dig deeper. This is a bit of geology and a bit of economics put together. The first thing, there is no such thing as an indefinite supply of oil. Even if you hit a particular deposit where your well produces a lot of oil on day one, this is kind of poking a balloon. As the balloon leaks or as the oil well is tapped for more and more oil at a certain depth, eventually the level at which oil is present is going to drop and oil production will decrease and stop. Production will drop over time. Secondly, even if you produce more than 90,000 barrels in that scenario that we used, if the price of oil drops by 50%, your dividends drop by 50%. And you, as the shareholder, have no control over whether the operator says, I'm going to spend the money to get 100,000 barrels out of this well over another well, because it may be cheaper for them to operate in another well. And if they do not take that oil out of your well, you get nothing. So what that means is that your dividends are highly variable. Both the price and the volume play a part there. They're also unreliable. The corporation may say, we're going to get our oil elsewhere. We're not even going to take a drop of oil from that particular well, and you get zero. If that sounds like it cannot really happen, watch out. Here is the stock price of BPT over 5 years. The low was $3 and the high 34. Even more interestingly, there was a period of around 18 months where they must have drawn 0 barrels of oil or very infrequent amounts of oil. There was a dividend payment right here that shows the low water mark, but there was a dividend payment there, which was barely anything. And so this shows the huge variability and unreliability of an oil trust. And if you look at the dividend amounts themselves, you can see that this was 9 cents. So all of 2021, the dividend was 9 cents. At its peak, it was $10. You do the math. 100+ times reduction in dividends over a 5-7 year period. And so the whole thing here is, as the well's production decreases, your dividend decreases. As oil price decreases, your dividend decreases. If you have a double whammy like COVID, where oil demand was low and price was low, then you get crushed. Your stock goes down to nothing and your dividend also goes down to nothing. However, if you were the lucky person who were to say, gee, I know that this reduction was really because of oil prices and oil demand, the well itself may have some more life left. And again, you got to be, I use this as the Warren Buffett spent cigarette butt analogy. If you don't know what that is, Google it. And Buffett would always say the trick is to find a spent cigarette butt, which is a grotesque analogy, but that's the point he's trying to make. You can pick it up off the ground, it's free, and if you take one puff out of it, it's a free puff. And so this is the spent cigarette butt here. If you made the calculation that the well has not dried up, it's just demand that has gone to zero, you would have gone from buying something at $3 that went up to 21. Not only that, your dividend payout would be an astronomical 70%. And so again, you would have to be the only person who knew that happened. But the idea here is that there indeed are some huge arbitrage opportunities here, and you have to understand the parameters of the trust, and you have to know the economic and also the geological, features behind it to truly understand what is going on. And that is the first trust. And you sit here and say, what happens when the timeline is done? Am I going to sell this back? Is it going to go to zero? Now, there may be new extraction methods that give new life to a well that previously went useless. So it may make a lower market price per barrel viable. There may be new products, new substrates that we can now derive at a lower cost. Clean energy transformation may come and destroy the economics in another direction. They may say we no longer want fossil fuel from this site, it affects the ecology of the area, or there may be lithium that is found there. So there are pro and cons and positive and negative and political and for and against. There are a lot of forces here, and you don't really have too much control over this. All you are is funding the acquisition of the land and sitting back and hoping that things work right. And if you are the lucky person, finding that used cigarette butt Warren Buffett talks about. Here is a second trust. This is called Brigham Minerals. The stock ticker is MNRL. And again, I'm not endorsing it. I apologize for the cough. I'm recovering from a long stint. And whether you buy it or not is entirely your decision. And MNRL has a different strategy. And what they do is they go find individual landowners, or they find even smaller trusts, and they get this large tract of land in certain geographies in the West Texas area, in the Delaware Basin, and so on. And they turn around and find prospectors or operators in big oil. And they say, okay, well, we're going to lease this to you. You take the oil, we'll take a percentage of what you sell it in the market for. Because this is a company, public company, they get to keep some of the other stuff behind the scenes. We don't exactly know how their revenue share works, when it starts, when it stops. But, they do disclose that they have some big names as operators. So Pioneer, that's PXD, that's their a symbol. Chevron, CVX, Occidental, OXY. When you can look at that, XOM for Exxon, and COP for ConocoPhillips. These are big national, international names. They get West Texas crude. Now, why will they need West Texas crude? Maybe there are geopolitical reasons. They are trying to make up for volume lost elsewhere. Maybe at a certain price, they can take oil from West Texas shale and sell it locally, and it is profitable, and they don't have to take it from far off lands and put it in a container and bring it in a ship and all of this kind of stuff, because they may produce oil at a lower price elsewhere. But big oil is indeed an operator of MNRL, or Brigham Mineral Trust. And so they pay royalties to MNRL, and there is a 10Q you can read more about. If you look at the dividend trends of this company, you make your own math. This is going on the upswing in terms of total dividends, but notice the dark gray, that's the extra dividend. So what is happening is, because of favorable oil prices, their regular dividend is going to be kind of sort of the same for the last 3 years, but the company is using some of its extra cash and returning it as a return of capital to the shareholders, and it's netting a 14% plus in terms of value to its investors. Here is a third one, MVO, or MV Oil Trust. And again, I'm not endorsing them. Buying or not buying them is entirely up to you. this kind of sort of shows halfway between BPT and MNRL in the sense that you can clearly see that either market forces or production volume or both. It's showing the trend where dividends are dropping, and during COVID it has its very, very low point. It does show an increase after COVID. Now, why would that possibly be? To some extent, it is because market prices has recovered. However, this company has a different MO. They go buy new properties and they add them to their portfolio in some scenarios. And so they may be adding more production as well. And it's up to you to decide whether that is the correct thing or not. And so the reason I showed you all these three is so you can understand how a typical stagnant trust moves over time. What is the use cigarette butt in that scenario? How something that is on the upswing looks like, and how something that is in the middle of both looks like. Ultimately, all of these are a very different risk profile for the typical yield investors. What you buy and when you buy is a personal calculation, and it's up to you to make. Realize that when that lifeline of that particular well goes to zero, you will indeed stop getting dividends, and it will move to a passive investment, at which point you'll get the fair market value, which may also be zero. And so they carry much higher risks. Beware and good luck. As always, here is my email. If you have any questions, I'm happy to answer. Thank you and Happy New Year. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.